Welcome back, students. Today I want to address the issue of leases, but the lessor accounting. Remember, the lessor is the legal owner of the asset. Now, we want to see how do you account for those transactions that are due to the actions of the lessor, right? Now, let's look at the introduction. The introduction says if Rule 16 requires lessors to classify a lease as a finance lease or operating lease. Technically speaking, the one that they classify as finance is the one which transfers the risk and rewards of ownership from the lessor to the lessee. Now, we are talking about a situation whereby someone bought a car through a bank facility, and now that person must repay the bank every month. After paying the last installment, the bank will transfer ownership. They will give that person the papers of the car, and then the car becomes a fully asset of the lessee, right? Now, when you look at operating lease, under operating lease, the transfer of ownership doesn't happen. It's just like when you look at a situation of a student and TUT. At the end of the TUT will never say, no, we give you the room, is now yours. You own it. No, the transfer of ownership doesn't basically happen. Now, you'll see that here they are saying the classification of a lease is based on the assessment of substance of the lease rather than the legal form. So what they're simply saying here is that in accounting, we report on the economic substance of a transaction. In taxation, they report on a legal form. Now, what is the difference here? Okay. Now, the substance of a transaction is this. If someone buys a car through a bank, now in accounting, we look at who is using the car for the better part or for the majority of the useful life of that asset. So if you buy a car from the bank, you are going to drive the car maybe for 5 years while you are paying. You keep driving and you keep paying, right? So the bank is never going to drive this car. By the time you pay them the last installment after 5 years, the bank will give you ownership. They've never driven the car. So in substance, the owner, according to accounting of the car, is the lessee in that instance, right? But legally, until you make the last payment, the bank is the owner legally. But accounting does not report on the legal part. They report on the economic substance of a transaction. Okay, so they look at that. Okay, when assessing the substance of a lease transaction, you'll see here, we assess whether or not substantially all the risk and rewards of ownership are transferred from the lessor to the lessee. So it's what I was saying now, that the issue of transferring ownership from lessor to lessee is a key in deciding whether something is finance lease or operating lease. So here they explain to you that a finance lease is the one whereby they transfer risks and rewards of ownership from the lessor to the lessee. Operating, no transfer. And the operating one, there is no transfer of ownership, right? So that's how they classify the two, right? Then we go to this example here, example one. Example one, finance lease and VAT, it's a lessor, right? So what happened here? AIM Limited on the first bought an asset, right, from Bo Limited for 115. Now 115 including VAT, right? So this company paid 115, which is AIM, right? Then AIM, like they're saying here, AIM paid cash for it. The same day, AIM leased the above mentioned asset with an economic life of 4 years to call for 3 years. And the equipment is for a qualifying purpose. So meaning they can claim VAT on this one, right? And all companies involved are registered for VAT. Right, so everyone here is registered for VAT, so they can claim VAT in this instance because the equipment is for a qualifying purpose. There's 3 installments payable annually on 31 December. Immediately when I see on 31 December and this transaction started 1st January, I know it's arrears because the payment is at the end, it's not at the beginning. If it was at the beginning, it was advanced, but this one is at the end of the year, so you can see it is arrears. The first installment is payable on 31 December, so it's more like they're duplicating this thing to me. The first and the second, they keep telling us it's arrears, but maybe they're emphasizing that we do not miss it. Then the value of this equipment is 115, including VAT. All right. The lessor finance VAT. So if they're saying the lessor finance VAT, it means the lessor paid 100,000 plus VAT of 115. Therefore, amortization table must start with 115, and the lessee has a liability of 115 also. In other words, the lessor paid the VAT over there. The lease term, okay, that's part we've explained. The interest rate and the VAT is 15%. Right. Warranty is over 3 years. The profit is 300,000 for all the years. And now, what is key here? Always read this word before. So they're saying it's 300,000 before taking into account the transactions of this lease, right? What can happen is that they can say after that. I will explain to you if they say after, what does it mean? It means you don't start by taking the transactions into account. You start by saying profit, then you go to temporary difference when calculating taxation. I'll show you when we go forward. Right. Now, what is the first thing that we must do? Required one, prepare the amortization table for the equipment. Right. There we go. This is the amortization table. It will start with 115 because the lessor finances VAT. It's 115. Now, to come here, you'll say 115 times 15%. It will give you this one, the interest, right? Then you've got the payment, right? So now, you see this figure here. I'm just going to demonstrate it once, this figure here. To get this figure, you must take this and that. They will give you this 33,117. Okay, 50,367 minus 17,250 gives you the 33,117. Right. So you always do it like that. It will always give you that. Right. Now, the closing balance by end of the first day is 881,883. Right. So some people you can calculate this for an example. This figure, the 813,883. There's a long way, there's a shorter way. I can take this and then say minus this. You'll see it will give you the 81883. Or you can do it the longer way. Say 115 plus this minus this. It will then give you the 81883. So it's 2 ways, right, to do that. So always understand something. You see this figure here? This figure is made up of 2 figures, the 17 and this 33, right? So it's split into those 2. Remember, when someone makes the payment of 50,367, that person is paying the interest and the capital repayment portion that must go against the 115. Okay. Right, this is your amortization table, your total interest that you're going to earn, the amounts that all the payments, or the receipt in this case, because it's a lessor, the lessor will receive all this month, repaying this total amount of 115. Right. Okay, required 2. Calculate. You're now calculating the current tax and the deferred tax. Okay. Now, here we go. We're here. So you are given the profit here of 300,000. Now, because you are the lessor, you must add the the lease finance income, which is your interest that comes from here for the first year. Okay. All right. You'll notice like for the other years it's this one, and then for the last year is this one. Okay. Your lease for a finance income, which is this interest part. Okay. Right. Then from there you reverse it, because the receiver is going to come and cancel it under temporary difference. Going to say, I'm canceling this thing. Right. You'll see even in the other years it's reversed here. Right. And then the receiver is going to say, as a lessor, what did you actually receive? How much did you actually receive? To say, I've received actually 50,367. Right. You'll see it's common all throughout the years. Okay. And then the receiver will say, right, I want to tax that 50,367, and I'm going to give you a warranty because legally you are the owner. Remember, SARS works with the legal part. Accounting works with the economic substance part. Right. Then SARS will say, I'm going to give you a warranty over 3 years at one from the 115 that you incurred. Right. So that warranty will be 38,333. Right. Okay. And then now some people will say, now SARS is giving us warranty, but there is no depreciation. Now let's differentiate between the two things now. This one of equipment is exactly the same as the one of the bank that I always make an example of when you're buying a car from the bank. This is what happens. Accounting will look at the economic substance and say the person that is using this asset is the lessee, and the lessee is the one that must depreciate. The asset must be capitalized in the books of the lessee and is the one that must depreciate. So you see, that is the reason why under the books of the lessor there's no depreciation, because depreciation is happening in the books of the lessee. Because in terms of the economic substance of the transaction, the lessee is the one that is using the asset, is enjoying this asset for the better part of the useful life of the asset, right? When you come to the lessor, the receiver is going to say, we don't report on the economic substance, we report on the legal part. The legal form says the owner is the lessor. We give the warranty to the lessor. Okay, that is why this situation is happening here. All right. Now your temporary differences, these ones, if it's in bracket, it is taxable. Taxable means a liability, credit balance sheet, debit income statement. There it is. Right. Then your tax is 312, taxable income is 312,034 multiplied by 30%, it will give you this one. Okay, so this is what is going to happen throughout the years. Right, you see the temporary difference for the following is 247, which is still a taxable, that equals to a liability, and that's why the 74 here is debit. Here this one is not a, it's deductible. This one deductible equals to asset, debit balance sheet, credit income statement. Okay, all right, so we've got the taxation part done here. What's the third requirement? Now we're calculating the deferred tax balance using the balance sheet approach method. Now, okay, number 3. Now we are here. All right, here's the balance sheet approach method. Now, this part here, we start with this one. This one is the end of the year balance. You can read this this from the amortization table. Okay, this is to what, 2020. By end of 2020, according to the amortization table, what is the closing balance? It's this one, right? By the end of 2021, it is this one. By the end of 2020, it is 0. Okay, so look at here, 81, 43, 0, right? And then this side here is 0, right? Now understand something. This 81 is like a debtor. The lessor raises a debtor, the lessee raises a liability, right? So the lessor is saying someone owes me money, I've given someone an asset, and this person in return must keep paying me every month, so they owe me this much, right? So this thing, you can analyze it the same way that you analyze PPE. Now, the tax base is 0, the accounting amount is 81883, so the difference is taxable, right? This one here is taxable. Taxable creates a liability, okay? Right, then we come to the tax part. The tax part, I can analyze it using this part here at the bottom. Your asset when you bought it is 115. You are allowed wear and tear of 38,333, right? If it, that gives you a tax base of 76. You'll see this is the 76. It's here also, right? When you minus again the 33, the following year takes your tax base to 38,334, which is this one now. Then you minus the last one, it takes you to 0. Okay. Now you will see here that if your accounting is 0, but you've got a tax base of 76 here, then this one becomes deductible, right? It's deductible. The difference between the two gives you the 52, which is taxable. Taxable equals to a liability in the balance sheet. 30% is that 1565, and in your income statement, it is a debit of 1565, right? And you'll see even here, here's the 1565. So it agrees, right? Then you'll do the same in the second year, 43. The 43 here, the tax base is 0, then the difference between the two, this one is taxable. Here, 0 to 38, this one is deductible. The difference between the two is taxable. When you multiply this, it gives you a balance of 1639. Obviously, if now the balance in the balance sheet is 1639, your opening was this one for that year, right? So the movement from here to here is the 74, this one, right? Which agrees to the 74 that you see here, right? So we'll do the same on the last year. That will also basically give you a 0 now, because everything is 0 now in terms of the tax basis and the accounting carrying amount. Okay, right, let's check what is my fourth requirement, journal entries. So I must do the journal entries. Here we go. Where are the journal entries? They're here. There. Right. Remember, they said we bought the asset on the first. So we debit the asset here. And then remember, it's a qualifying. This one, you claim VAT. And then you raise your 115 for VAT. Then you pay the bank the 115. You're buying this asset. Then after doing that, then you claim this VAT. You'll see the receiver is going to pay you, and you then cancel this for VAT. Okay. Now, then you take the asset and you give it to the lessee as the lessor. Once you take the asset and you give it to the lessee as the lessor, you must raise a gross investment, which is a gross debtor. Gross debtor. It's a debtor. You can see it's even written receivable here. All right. Your gross debtor, it means it must be the asset including the interest. It's gross. It includes everything. So what includes everything in this thing? Let's look at the amortization table so you can see. Right. This is payments of this one. Right. It is payments that include the capital repayment, which is 115, the amount of the asset, and the interest. If you add the two, they will give you this one on 151. So the gross that includes everything is 151, which is made up of 50,000 times 3, and you raise this data here. Say, these people owe me. In total, they owe me 151,101, which is the asset that I've given them plus the interest that I'm supposed to earn on this transaction. Right. Now, remember, the asset here, if you look at the first journal entry, this one, it was debited in the lessor's book. But now the lessor is taking the asset, is giving it to the lessee. So the lessor, if you look at the economic substance, is like selling the asset to someone else. So the asset must be eliminated from the books because it's given to someone. So you'll see he's raising a credit here of 100. He's taking the asset out of the books to say, I'm giving it to someone else, right? And then he's raising 36,000 to say, over the lease term, over this lease term, I'm going to earn a finance income. But you see, it's called unearned because by 2021 January, the lessor has not earned anything of that 36. He knows he's going to get 36,000 from this transaction, but he has not earned it. Now, how you earn interest, we all know that interest is earned over a period of time. As the days go by, the months go by, the years go by, you earn that interest, okay? It's time that determines when you earn interest, you see. Right. Now, it's not yet earned, but every year he's going to earn it. So it's 36 here that he's going to earn over the life of this asset or over the lease term, right? Then you've got the VAT that the lessor, because now he's taking an asset, is giving it to someone else. The receiver is going to treat it like it's a sale, like you've sold it. And remember, when you sell something, you will be charged output VAT, which is that one, the 15,000 that you see, right? And then the lessor will have to pay. Now, this 15,000, you see, is paying the 15,000 to the receiver, right? Then we go to the next transaction. Now, when the lessee pays, it's debit bank because now the lessor is going to receive money in this case, okay? Why is the lessee paying the lessor? Because he's settling a debt, right? Then we go to the next part. Now, remember I said interest, you're going to earn it over a period of time. Now, it's the end of 2020, so we must earn interest for the first year, right? You see, we are debiting the 17,250 against this account that is called unearned in the balance sheet. So you're debiting against this 36 here. So this 36 is going to decrease now. See, it's sitting as a credit in the balance sheet, right? As you earn, you debit. You see, it's debited now. So it's decreasing because this income has been earned now. You see, it's reaching end. For this year, we've earned it now, right? There's end in a finance income. Okay, second year again, first payment, you're paying the debtor. Second, you see, we are debiting again the balance sheet amount of 36, the one that we have. So it keeps decreasing. It decreased by 17 in the first year, now it's decreasing by 12, and then you've earned this interest. You go to third year, the same thing, you pay the debtor, so you get paid, you debit the bank because you are receiving money from the lessee, and the lessee is paying the debtor, which is a gross investment in lease, right? And then you earn the interest, the unearned you debit, then the end one, which is income, you credit. Okay, we've ignored the tax journal entries in this one, but if you were answering in an exam or in a test, you are required to put those ones. Okay, now we go to the last requirement, requirement 5. We want to see the disclosure, the notes that you have to put, but we're only limiting it to 2020. We are not doing all the years. Okay, right, let's go here. Right, the first one is this one. Okay, you will put the finance income under profit before tax, 17,250. That's the interest end for 2020. And then the second one is this one. It's a fairly simple one, the second one also. In short, they're saying you started with 115 in the lease. The person paid 50,000. The interest for that was 17,250. The closing balance is 811. If you look at this note 2, this is the lease during the first year. The lease transactions during the first year, and you can easily go and analyze these transactions when looking at your amortization table. For an example, right, in your amortization table, you started here, and here's the payment. Here is the interest, and your closing balance by end of that year is 81, which is the same thing. If you look at here, they're just rewriting the analysis here. 115 payment, interest, and you see the balance is still the same as the closing balance in the amortization table. Okay, right. Then the third one is this one, the maturity analysis of future lease payments received. This column is the payment, the gross investment undiscounted. These are the payments that are remaining. Okay, the remaining payments in 2021 is this one, 2022 is this one. Then your interest and finance income is this one for that year, and this one is for that year. All right, and then if you deduct this 12, for an example, from the 50, it gives you this 38. The difference between the two, it gives you this 38. The difference between the 50 and the 6,570 gives you the 43. Right. If I add this amounts, you can see it's 18. This one is 100. But look at the net column. Look at the net column. Do you see this amount? Is exactly the same. It's a closing balance by end of the year, which is this one. There at the top. You can even go to the amortization table and look at the balance by end of 2020. You'll see it's that 81, right? Okay. Now let's summarize the second one. The second one is more or less like the first one, but the difference is that now here we are dealing with the situation whereby the equipment is for non-qualifying purpose. Okay, a lot of things are the same except a few things that will change. Okay, let's look at the few things. The amortization table is still the same, nothing will change. Tax still the same. All right, balance sheet approach still the same. Here is where the difference is. Look at the first journal entry. There is no VAT there. You see, now you're capitalizing the asset at 115, right? There is no VAT in this one. And then look at you cannot pay VAT or claim VAT because there is it's a non-qualifying, right? And then you'll also look at this one. Everything is still the same here, except you see this asset now is capitalized at 115 because it's not qualifying. Okay, that's where the difference is on this first one and the second one, right? The second journal entry. The rest of the things still the same as the first one. See, they're still the same as the first one, right? Even the disclosure, you see, still the same. Nothing has changed, right? We will get to this example in the next video, but for now we want to limit what we are doing to up to here. I will then redo the next video in terms of example 3, then we can take it from there. Thank you.